Good morning. It's Monday, the 9th of December, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take, it's the uncertainty machine. In February 2021, almost 4 years ago now, reports emerged that the internationalization of the rupee was inevitable but would complicate the formulation of the monetary policy. This was attributed to the Reserve Bank of India's report on currency and finance. Internationalization would mean that the rupee could be freely transacted by both resident and non-residents. And here's the important part, it could also be used as a reserve currency for global trades. The report also said that while this ideal world would lead to lower transaction costs of cross-border trade and investment operations by mitigating exchange rate risk, the ideal world is fine. It would make the simultaneous pursuit of exchange rate stability and a domestically oriented monetary policy more challenging unless supported by large and deep domestic financial markets that could effectively absorb external shocks. What this means is that if you were to visualize it, think of a market or an economy like the United Kingdom or the United States where there is free flow of currency and capital. So it's not just clear whether the Reserve Bank of India was advocating for internationalization or just pointing out what it would take. Reading between the lines, I would conclude the Reserve Bank of India was assuming that the former was inevitable, to use its own words, and the latter, which is the domestic monetary policy stability part, was what we had to work on to ensure that it worked out well. In short, several leaps of faith, at least as I could see. Now, the Reserve Bank of India has been careful to use the term internationalization of the rupee, though it does appear that it is nothing but code for de-dollarisation because it largely means the same, at least practically speaking. And more on that shortly. In March 2023, another headline, or perhaps headlines, said the rupee was closer to replacing the dollar as 18 nations had agreed to trade in the rupee. The article referred to a statement in Parliament by India's Union Minister of State for Finance, who in turn referred to a July 2022 circular from the Reserve Bank of India permitting invoicing of international payments in rupees. He also said the Reserve Bank had given approvals to several banks to open special rupee Vostro accounts or SVRAs, which allowed for settling payments in rupees. While those countries range from Singapore to Sri Lanka and Malaysia to Seychelles, that's the island and holiday destination, the key one was obviously Russia, from whom India has purchased large amounts of crude oil in the last couple of years. Russia, itself a pariah since it invaded Ukraine, has been floating all kinds of trial balloons on alternative currencies, including a BRICS currency last month, which is quite likely what got Mr. Trump worked up. Now, to be fair, there is nothing wrong in aiming to create a currency reserve of your own, though there are problems when an idea gallops faster than the strategic plans to ensure its arrival are made. Now, that includes growing an economy to a certain scale and achieving the resultant economic might that goes with it. Since no other country has done it, including China, whose GDP is 5 times India's, it is fair to say or expect that nothing will happen in a hurry. And when incoming President Donald Trump said he would slap a 100% tariff on countries who wanted to start an alternative currency, when the prospects for such a currency were in itself so far-fetched, it was interesting to see the reactions. India's External Affairs Minister S. Shankkar said at an event in Qatar's capital Doha on Saturday that BRICS countries have no interest in weakening the US dollar at all. The Reserve Bank of India Governor Shankkar Aiyar on Friday, while announcing his credit policy, said that as far as India was concerned, the country had not taken any steps specifically aimed at de-dollarization. All that we have done, he said, was permitted the opening of Vostro accounts and entered into agreements with 2 countries by now to do local currency denominated trade. Now, this, he said, is to de-risk our trade. Dependence on one currency can be problematic due to appreciation or depreciation. To be fair to Das, he's never used the term de-dollarization in the past, at least in an aggressive way, and broadly held the same stance. But India's almost abrupt leap to clarify is a little puzzling. If we had a position on internationalization of the rupee, however long a project it was, why would we take a visible step back? Unless it's all in the semantics, which is that we will pursue internationalization of the rupee, but not de-dollarization, which should keep you, the United States, happy. Barry Eichengreen, professor of economics at University of California in Berkeley, writes in the Financial Times over the weekend that the dollar will get stronger in the short term and then start getting weaker. He also projects that the Eurozone and China might allow their currencies to depreciate, which will increase their exports into other countries. Most of all, he argues that economic policy uncertainty has a strong negative effect on investment. And Trump, he says, is an uncertainty machine. So while we figure out where we want to take the rupee, it is wise and would be wise to remind ourselves that certainty in policy matters most when it comes to the entire spectrum of investment and economic activity, which also includes hopes for creating a reserve currency. And that brings us to the top stories and themes for the day. The stock market's pause after a 5-day streak could pick up positive Wall Street cues. Can the Sensex go up to 105,000 in a year? Forex reserves rise $1.5 billion after falling $48 billion in 2 months. Why is India gearing to raise goods and services tax on a variety of items?
This is a core report with Govindraj Ethiraj.
The markets could pick up positive Wall Street cues. The stock markets paused on Friday last week after a 5-day winning streak following the Reserve Bank of India's move to keep its key interest rate unchanged at 6.5% on Friday. Moreover, the Reserve Bank lowered the economic growth forecast to 6.6% for this year from its earlier projection of 7.2%. It also cut the cash reserve ratio, which banks keep or rather required to hold, and thus easing monetary conditions against, of course, slowing economic growth. Now, most, if not all of this was not a surprise. So the Sensex was down marginally by about 56 points to 81,709, while the NSE Nifty 50 was up 30 points to end at 24,677. Economists are now betting on a rate cut in February, and let's see if that happens. Meanwhile, the bullish reports have resumed, this time from Morgan Stanley, though with some prominent caveats here and there. According to the US brokerage, India's stock market may emerge as a standout performer amongst emerging markets in 2025. It said on Friday, according to a report in the Economic Times. The brokerage has forecasted with a 30% probability that the Sensex could soar to 105,000 in a bullish scenario, which means strong earnings growth, macroeconomic stability, and robust domestic capital inflows. It also has a base case scenario of 93,000, reflecting a 14% upside from current levels. And the bull case, by the way, projects an earnings growth of 20% annually for 24 to 27. That's 24, 25, 26, 27 years under this scenario, and 17% in the base case. But there is a bear case as well, which is the Sensex dropping to 70,000, and that represents a 20% decline. A trigger for that is oil going above $110 a barrel, the US economy slipping into recession, and a bunch of other things, which is the opposite of everything that could happen if the markets were to rise to that 105,000 level. And if it is the bear case, the Sensex earnings could compound at 15% annually till 26. I did not see any discussion on Trump tariffs, but presumably it's not easy to predict the unpredictable. Morgan Stanley, of course, is returning to base like many other foreign investors who appear to have exhausted their selling quotas for now. The first week of December has already seen about $3 billion of net inflow from foreign portfolio investors. Remember, October and November saw huge outflows, with October alone seeing over $11 billion of outflows. Meanwhile, on Wall Street, the party continues. The Standard & Poor's 500 and Nasdaq Composite hit fresh records on Friday after November jobs data came in slightly better than expected. The broad market S&P was up, and so was the tech-heavy Nasdaq, thanks to gains in Tesla, Meta Platforms, and Amazon. Both indices touched new all-time highs during the session and closed at records, according to CNBC, though the Dow Jones Industrial Average fell slightly, about 123 points, to close at 44,642. RBI holds interest rates. Some Friday news to recap, since it is important. The Reserve Bank of India kept its key interest rate unchanged on Friday, but cut the cash reserve ratio that banks are required to hold for the first time in 4 years, effectively easing monetary conditions as economic growth slows, according to Reuters. India's GDP growth rate had fallen to 5.4% for the July to September quarter. Now, that was the slowest in 7 quarters. And inflation, of course, is rising, and the rupee has hit record lows, and more on the rupee in a short while. The cash reserve ratio was cut by 50 basis points to 4%, effective 2 tranches on December 14th and December 28th. And this is the first cut since March 2020. This move is expected to bring in about 116,000 crore rupees, or about $14 billion, into the banking system. The benchmark repo rate is holding at 6.5% for the 11th straight policy meeting. Elsewhere, oil is holding steady at this point, around $71 a barrel, lower than the numbers we saw last week. Remember, there is continuing tension in the Middle East, though the action has shifted to Syria, where there has been a regime change. India's Forex reserves rise after dropping. The country's foreign exchange reserves rose for the first time in 9 weeks and stood at about $658 billion as of November 29th, and thus coming off 5-month lows, according to data from the Reserve Bank of India reported by Reuters on Friday. So the reserves rose by about $1.5 billion, but had dropped about $48 billion cumulatively in the last 8 weeks or 2 months. The Reserve Bank of India, as we know, intervenes on both sides of the Forex market and tries to curb undue volatility in the rupee, thanks to which the rupee has been considered amongst the steadiest currencies or most stable currencies in recent years across the world. The last 2 months have seen sustained pressure, which has obviously made all of this difficult thanks to foreign portfolio outflows and the dollar strengthening following Donald Trump's victory in the US presidential election. The Reserve Bank of India Governor Shaktikanta Das said on Friday that the Reserve Bank of India's central tenet is to maintain orderliness and stability in the exchange rate without compromising market efficiency. So the rupee ended at about 84 rupees 68 paise on Friday. That was the fifth consecutive weekly fall, and it had hit a record low of 84 rupees 75 paise during last week. Why is India likely to raise goods and services tax rates? Last week, several news reports emerged and suggested that there would be an increase in goods and services tax or indirect tax on items ranging from tobacco and aerated drinks, including about 150 products in all. A group of ministers, or GOM, is believed to have recommended a slew of changes in these rates, beginning with a 35% slab for sin goods. Sin goods, of course, include tobacco. The proposals included raising GST to 18% on products priced between 1,500 rupees and 10,000 rupees, 28% for goods priced above 10,000 rupees. For instance, the GST on wristwatches priced over 25,000 rupees could go to 28% from 18%, and shoes over 15,000 rupees could attract 28%. Apparel was not spared, leading to the Clothing Manufacturers Association of India warning that the rise in rates could lead to a loss of 100,000 jobs. A day later, the Central Board of Indirect Taxes and Customs clarified that the reports in media on the basis of a group of ministers' deliberation is premature and speculative. Veteran economic journalist and author Shankkar Aiyar wrote a column on this theme in the New Indian Express over the weekend, where he argued for greater transparency in the process of setting goods and service tax rates and greater involvement of taxpayers as well ahead of a December 21st GST Council meeting in Jaisalmer in Rajasthan. So the larger question, of course, to me, and I'm sure to you too, is why now and what is this bill being presented for? So I began by asking Shankkar Aiyar exactly that and what he thought was the reason for the likely GST hike at this point, whichever ones finally come through.
So it's a mystifying question. I mean, problem with the GST Council's process and systems is that they appoint a GOM on issues. For instance, there is a GOM on reducing GST on health insurance, which is understandable, and we could have a discussion about it. The second, there is another one on compensation set. Now, GST is roughly 7 years old, and still we are talking about a compensation cess. So the rationalization for that is not available. This GOM has been talking about rationalizing the rates. So if you know, the GST has multiple rates, multiple definitions, confusion, cess, and stuff like that. So to me, the first thing that struck me is, why would you increase rates when demand is waning? So, that's like the Eco 101 question. But beyond that, that's really my beef, in the sense that why is the GST Council setting up a GOM on rationalization? What is the objective of this? They should define. So the terms of reference don't give you any, there is just a circular saying so-and-so, so-and-so, and ministers are there, and it is convened in this particular case, the Deputy Chief Minister of Bihar. So why is the GOM set up? What is the objective? What rationalization do they want? Do they have a target for GST growth? Do they think that GST growth is not up to the mark? What is driving the need for the rationalization? Is it simplification of the process, or is it for higher revenues? And if it is for higher revenues, then they should explain that this is fallen, or this is the rate of growth that we expect and this is not coming. I suspect some of this has to do with all the populist schemes that have been announced by state governments in the run-up to elections in the past year and more. For instance, the cash benefit transfer to women across states, some 8 or 10, the estimate is that it is 2 trillion rupees. We know from the GDP data that government capex has fallen. We know from state government finances that revenue expenditure has gone up. They are missing targets on investment in infrastructure. So all of these requires the GST Council to come upfront and say, A, this is what we are doing. B, this is why we are doing. C, this is the objective that we aim to achieve. And the process is completely opaque.
I'll come to the process in a moment, Shankar. But if you were to look at the core of what has been suggested, it ranges, like we mentioned earlier as well, that some products could go to 18%, some could go to 28%, wristwatches above 25,000 from 18 to 28, shoes over 15,000, 28%. And apparel is a key part of this because there's obviously apparel has become expensive also. And the Clothing Manufacturers Association put out a public release saying this rise in rates would lead to a loss of 100,000 jobs. So my question is two questions actually. So one is that this is obviously inflationary in itself, isn't it? And second is that if they were to raise the rates, would that really achieve what they are setting out to achieve, which is, actually raising revenue? Because I'm assuming there's some demand hit that will follow.
So that's one of the questions that I've raised. Have they estimated, or is there been a study of how much revenue potential lies in what category of price points? Do they think that the demand in that category will sustain? The more important question is that in an economy where the top end of the economy is sort of holding the consumption, which is sort of weak, why would you go and tax them? And then the question of inflationary is obvious. I mean, there will be an impact on the inflation if you sort of raise rates across 150 different products, even if they raise from say 5 to 12 or 12 to 18 or whatever. I can understand them wanting to curb use of sin goods like tobacco, aerated drinks. By the way, alcohol is still with the state government. So have they increased rates there? That is one of their biggest revenue sources. So the state governments are simply getting a pass in this. I mean, all the social media outrage was on the center, and the center has obviously the veto power, so to speak, in the GST Council. But state governments, the opposition parties in state governments, they are sort of hunting with the hounds and running with the hares. I mean, this is duplicity. You say that, inflation is going up, this, that, and then you have a committee of people from finance minister from Kerala, West Bengal, Karnataka, all participating in one GOM, which is happily saying that, we need to increase rates. So the process requires some amount of public consultation.
If you were to go back to the genesis of this, which is there is a bill that is being presented or has been presented, and someone has to pick it up. And who do you think is going to pick up the bill then? And in what other ways could it be presented?
Obvious question for any government is how they manage their budget and how they manage the left and right hand side of the Excel sheet. So, what are they doing for expenditure control? What are they doing for efficiency? First question. Second, all taxation is about income and consumption. If growth is tapering, then your presumption that consumption will continue. I mean, the government of India and the state governments must be the only entities in the world which think there can be a market of sellers without buyers. I mean, how do they explain this contradiction that here's 5.4% growth rate? The RBI has pulled down the estimates. All economists are now saying 6 to 6.5 for the whole year. And in that, you have to actually look at what is the logic. And which is why I argued that there is parliamentary standing committees invite submissions, like, feedback from citizens. The RBI regularly does studies and it invites stakeholder comments. The union budget is passed in parliament for whatever worth it is worth. There is some debate and deliberation and voting happens. And there is a distance between the presentation of the budget and the implementation of the budget. The GST Council is the only entity where, they come and say, okay, this is what we are doing. And thereafter, if there is a sort of outrage about Khakra tax or this tax and all, and then there is a U-turn. Why wouldn't the GST Council follow what is followed in parliamentary standing committees or followed by regulators. This is like, the primary requirement in any democracy is to have some stakeholder comment. I mean, for sure, you and I, if we say that we disagree with something, or an industry association disagrees with something, I mean, for instance, all this apparel stuff, have they conversed with the industry association, the apparel manufacturers? I mean, apparel is the small, medium, and micro enterprises who employ the bulk of the formal sector employment. They are also on the frontier of exports. Companies like Walmart and all are sourcing from them. And then you go and sort of say that, okay, I'm going to raise rates on apparel from this to this. Those companies have to survive to export. So, simple point in the column was that there needs to be a better way of doing these things. I mean, surely the GST Council, it is not superior or at a higher intellectual plane than the Parliament of India or the Finance Ministry, which presents the union budget. That there has to be some coordination, some collaboration in how you fix the rates in an economy, particularly when you are faced with an uphill challenge ahead.
Right. Shankkar, thank you so much for joining me.
Thank you, Govind.
That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.